Hello friends, in this video we will talk about what is monetary policy and how it impacts the stock markets. So let's first understand what is monetary policy. The monetary policy is a tool with which the Reserve Bank of India controls the money supply by controlling the interest rates. They do this by tweaking the interest rates. RBI is India's central bank. World over, every country's central bank is responsible for setting the interest rates. While setting the interest rates, the RBI has to strike a balance between growth and inflation. In a nutshell, if the interest rates are high, that means the borrowing rates are high, particularly for corporate companies. If corporates can't borrow easily, they cannot grow. If corporations cannot grow, the economy eventually slows down. So, what this means in a nutshell, if the interest rates are high, that means the borrowing rates are high, particularly for corporate companies. If the corporates can't borrow money easily, they cannot grow. If corporations can't grow, the economy eventually slows down. On the other hand, when the interest rates are low, the borrowing becomes easier. This translates to more money in the hands of the corporations and consumers. With more money, there is increased spending, which means the sellers tend to increase prices, leading to inflation. So, friends, in order to strike a balance, the RBI has to consider all the factors and should carefully set few key rates. Any imbalance in these rates can lead to economic chaos. The key RBI rates that you need to track are as follows. The first is the repo rate. Whenever banks want to borrow money, they can borrow the same from RBI. The rate at which RBI lends money to other banks is called the repo rate. If the repo rate is high, that means the cost of borrowing is high, leading to a slow growth in the economy. Markets don't like the RBI increasing the repo rates. The next is reverse repo rate. Reverse repo rate is the rate at which RBI borrows money from the banks. The banks lend the money to RBI, they are certain that the RBI will not default, and hence they are happy to lend their money to RBI as opposed to the corporates. However, when the banks choose to lend money to the RBI instead of corporate entity, the supply of the money in the banking system reduces. An increase in the reverse repo rate is not great for the economy as it tightens the supply of money. The next is cash reserve ratio. Every bank is mandatorily required to maintain funds with RBI. The amount that they maintain is dependent on the cash reserve ratio, or commonly known as CRR. If CRR increases, then more money is removed from the system, which is again not good for the economy. The RBI meets every quarter to review the rates. This is a key event that the market watches out for. The first ones to react to the rate decisions would be interest rate sensitive stocks across various sectors, such as banks, automobile, housing finance, real estate, metals, etc. So friends, that's it for this video. If you like this video, do subscribe the channel for more further videos. Till then, happy learning. See you again next time.